Hey, everybody. Hope you're all doing amazing. It is about 6:45 Central Time. We're going to start in about 17 minutes. Hope you guys are all having an absolutely amazing day. I'm going to throw a screen share up so that you're not necessarily looking at my funny looking mug. But we will start at about I guess that's about 15 minutes. So see you in just a few minutes. Hey, everybody. Hope you guys are all doing great. We're going to go ahead and kick this thing off here in just a minute. So get your, just get your coffee rolling, get everything going, and then we will start in just a few minutes. All right, everybody. Hopefully, you can all hear my voice, and we are live and we are rolling. I want to welcome everybody to our session this evening. I will tell you, this is brand new for me. This whole YouTube live concept. So the first thing I would ask for is a little bit of grace. I'm brand new to this, so a little bit of grace would be much appreciated. So for those of you that are watching live, awesome. Those of you that are watching this on the recording, read the chat box, ask whatever questions you can. For what I'd like to do over the course, I've scheduled an hour for tonight's session. We may go less than that. We may go more than that. We'll see kind of where it takes us. Oh, Ingrid, I always have my coffee, but that's how I roll. So we may go a little bit longer, a little shorter. I'm not sure. It depends on where it takes us. The purpose of this session is really, I thought it would be kind of neat. I've never done one of these. I've seen a couple of them on air. I tried them a few times. We had a test one the other night, and it seemed to work out pretty well. And I've had a lot of people that have asked me specifically about getting Eric on some of the stuff that I do, primarily because I talk a ton about options and I am huge into options. And so Eric is one of the smartest guys I know regarding options and trading in general. We talk a lot about just kind of overall what's happening in the markets. And here's one of the things I heard from tons of people was, what's Eric's take? Or the thing I always hear is, man, I really want to hear what Eric's take is on the economy. Or I typically hear, I want to hear him rant, right? And so what I thought would be kind of neat is for us to get a chance to kind of hear from Eric and get his thoughts and get his concepts. He's actually going to come to Houston and teach an options class with me in next month, which I'm super excited about. It's going to be awesome. So I think what would be kind of cool is if I turn on Eric. You there? You want to turn your mic on, say hello, introduce yourself to people that don't really know you.
All right. Yeah, I would like to introduce myself. Brand new audience, people to influence, infect, and annoy. So it's been a while since I've actually been behind the mic. Left OTA 8 months ago, so not doing a lot of ranting on the air. Just mostly to anybody who'll listen as I walk down the street. So my history: I worked at Online Trading Academy for 10 years. Sharing the knowledge that I accumulated as a floor trader in Chicago from 1989 till 2006. That was a fun run. It was the fraternity of an amazing adventure, but then the computers took it all away, and you ended up having to do 10 times the work for the same amount of reward. You'd take a lot more risk in order to ring the bell. And you can't go home again. You can't go back to high school. It's not the same, and everything evolves. But that time on the floor and in Chicago Board of Options Exchange, 23 years old, hitting the floor, man, I was trading like options were crack. I loved it. You could not fall into a greater profession, and I'm telling you, falling into it was exactly the way that it happened. I like to go on a little bit of a how can I put it, just an expression of life when I tell you how I became a market maker. I mean, everything about life is identifying an opportunity, And then after you see the opportunity, is it worth taking that opportunity? And then the third part is, do I feel that I have the ability to actually utilize the opportunity from myself? Because you could be in the right place, okay? You could be at the right place at the right time, okay? But unless you're willing to take advantage and have confidence in yourself that you can take advantage of that right place and right time, then you don't get anything done. And that should just be a general statement when it comes to learning how to trade or learning how to do anything in life. It's to take on things that you're not sure if you can do it, but the first thing you have to do is not say, I can't. And with the proper training and the right amount of mentoring, you will find that you probably can. I used to have this statement with my roommate back when I was a poor man living in Chicago with one of my another clerk on the exchange, and he would say, "I'm thinking about remodeling my bathroom." It's like, okay, do you think we can do it? My answer would be, why can't we do it? So if you go into life thinking that you can do it, and you take these opportunities when they come to you, then you might surprise yourself that you can actually do it. And it was the best decision that you've ever made. And my life has been a series of, well, why can't I? Because what is the downfall of asking a question? What is the downfall of looking something up? Or of going to somebody that you don't know? And like that movie, what is it, 6 Pounds with Will Smith? And it's like, what do you do and how do you do it? That's not just written for a movie. Successful people do what other successful people do. And if you just will yourself to go up to that stranger, he's not going to throw a rock at you. He's not going to punch you in the face or spray you with mace, most likely.
Depends on what you're wearing that day.
I know. Sometimes you're asking for it. But the bottom line is you got to go and you have to explore that opportunity, because odds are that first exploration into that opportunity doesn't cost you anything other than possibly your pride or a unrealistic fear that you just can't get over. Anyway, that's the gist of everything. And if you have, because everybody out there, everybody who built a fortune didn't start off knowing how to build a fortune, didn't sit out with, except some trust fund kids. They went out and they explored the opportunity and said, maybe I can do that. Let me look into that. And it's not really a rant, because I'm not jumping up and down when I say this, but I tell you that people that sit on their hands waiting for somebody to knock on your door and say, here's your money, I've been looking for you. Or as my grandmother would say, a cute girl isn't going to just knock on the door. You got to go out there, son. And you have to take those chances. And odds are the chances that you take are very minimal in magnitude when given the upside potential of what you can do. And I just want to put that out there.
Nice. Well, that's the old school time when you actually had to knock on the door. Now people just swipe right and swipe left.
That's right. It's just horrible. You don't know how many. They should send you a report showing how many times somebody swiped left, just to keep your ego in check.
Nice. So what I'd like to do, Eric, thanks for that. I think it'd be kind of neat if we just kind of overall talk markets in general, right? And what we think and see from an overall kind of market perspective. I do, and I'm sure you don't watch them every day. You got other things to do, but I do a kind of a daily market commentary on really the things that I look at in the markets from a day trading, for the most part, swing trading perspective, using 4-hour and hourly charts. And I thought maybe it would be kind of neat for you and I to kind of both take a chance to look at some things together and give our thoughts on kind of what we think is going overall. So first of all, real quick, if I can just get a quick yes or no in the chat box. I know that there's a slight delay, but if you guys can let me know if you can see my screen. I'm sharing my desktop. while I'm waiting for somebody to let me know. Okay, perfect. Awesome. So, Eric, you can kind of see my screen and see what we're talking about. And most of the lines that I have on here, and just kind of for your edification, Eric, because I don't know if you've watched the daily video or not, I'm a big believer in I draw lines on the charts and I leave them there, whether I'm right or whether I'm wrong. Because frankly, number one, it's true accountability, right? I'm doing this dang video every day. I gotta be accountable somewhere. And so you're going to see a lot of lines on this charts, and a lot of these are areas that we've not tested in a really long time, and we may not get back to. So I'm not sure. Do me a favor. Let me guys know in the chat box. Anybody who took this is the reversal trade. Actually, we talked about this one yesterday in the room, and then this is the breakout that we talked about as well. So both of those are kind of running nicely. But from a big picture perspective, Eric, we talk a lot about the big picture perspective, just, when you and I kind of get on the phone and hammer through, looking at the S&P from a big picture perspective, what's your overall thoughts on current market environment from a directional perspective, and then maybe even from a volatility perspective?
All right. On a big picture, I'm a big fan of it is what it is till it isn't. Okay. I am macro in nature. Weekly is the smallest time frame I really want to look at. So not a lot of it, no intraday trading, no up on the screen. It's all big picture. And the reason for that is if you followed the way that the market has moved for the last 10 years, you'll see that there's a subset of individuals that you may have been acquainted with that were always looking over to the left and looking for reasons to short the market. Oh, we went up X number of percent, or we went to this level and we looked over the left, and then there would be somebody in some sort of virtual classroom saying, oh, we got to take this short. Oh, we got to take this short. And every time the market went higher and higher and higher, it wasn't, let's look for a pullback to buy this. It's like, there's a level up here, let's start shorting it. There's a level up here, let's start shorting it. And the majority of the people that listen to that mentality, they ended up missing a 10-year bull market or a 9-year bull market. And some people were actually chastised by the fact that they kept calling for the market to retest 2008 levels or retest. If Europe's going back to 2008 levels, we have to go to 2008 levels. And that was the mantra that you heard from a lot of folks back in 2011 when we had the European financial crisis.
Right.
But the reality is that Warren Buffett didn't get rich looking at a 3-minute chart. Okay. Warren Buffett doesn't sit up on his laptop wondering where the European markets are opening so he can try to steal, 50 cents here or $1.50 here. So when I look at investing, now trading's different. Investing, this is what I'm talking about, you have to be in it until you shouldn't be in it. Now that seems like it's something very simple to say, but the reality is you can tell if you're making higher highs and higher lows. You can tell, and again, I'm a big proponent of using a 20-period exponential moving average as my determination of trend, that if we're above that trend line, we should be looking to buy the dip, buy the dip, buy the dip, and look at your smaller time frame levels to where you want to join into that uptrend. And you're not really looking, unless you're going to have a portion of that investment dollars be swing dollars, to get out of it. Okay, if you pull up a chart of Apple and you look at how that stock has gone up in the course of the last 10 years, there were plenty of reasons for you to get out of that trade. I mean, go back to 2016, it's trading $100. Go up to 2018, it's trading $233. I guarantee you that on some smaller time frame, there was a reason that somebody said, get out of this trade. But the reality is Warren Buffett buys this stock sometime in June or August at $91, $92 a share, and he's not dumping it out at 95 or 100. In fact, he was still buying, though I did ridicule him via Twitter, that he was still buying it when it was trading 200, and it still went up another 15% from there. So the key is you want to stay in these macro long positions until something changes. Now, unfortunately, we might be at a point where things are changing. And if you look at the S&P 500, or the ES, I should say, 2640 is a very important level. Look how many times we've gone down to it in the last month and a half, and we've rifled off of it. Well, we're going to run out of time from rifling off that. We had a huge move where we ran up after the election. Then we had another huge move, and where we retested because of some positive trade talk or whatever. I don't remember what that was. And then we came back down.
Eric,
and there's
what I look at what I look at based on kind of where we are, and I don't know how often you look at these, but I'm a huge believer in looking into candlesticks, right? So, for example, like you just said, these two upper wicks, these long upper wicks, what those tell me, and I don't know what, kind of how you read it, but this tells me that buyers kept trying to come in. And at some point, the sellers were basically no soup for you, right? We're not interested, kind of driving it back down. To me, that's a humongously bearish signal, especially in an area that's been tested a couple times.
Well, definitely. And if you follow, there's a Twitter site called Zero Hedge. I'm not, sometimes they're a little too bearish. So you gotta take what they're given, but they're very good on up to the date. What was just said. Was there something about trade? Was there something about this? Because it's the first place I go to, and all of a sudden the market moves in a weird fashion. All of a sudden it pops. Then you go to Zero Hedge and you look at the tweet, and it's like, oh, Trump just said this about that, and that's why the market moved. But they had a recent Twitter story. I don't know what they're actually called, where they listed off the number of hedge funds that are shutting down, and it was a large list. And whether they become not longer hedge funds or they just become a home office, which is the same thing as shutting down, there's a lot of funds that are liquidating going into the end of this year. And a lot of folks had planned on an end of the year rally. Why not go with the odds? But it looks like that every time we do get a rally up, there's selling. And I'm not sure if it's really selling to get short. I think it's just hedge funds that are liquidating, and they're eventually just going to go off the board by the end of the year because of such poor performance. I mean, you have people like that Paulson guy. He has hedge funds that he's going to make it a home office. He's shutting it down. There's a lot of big names out there that have been beaten to death this year, and they're shutting their doors. So we could see more of that. More end of year liquidation, because at the end of the day, we still have Mueller, we still have trade, we still have Brexit, and what's my motivation to buy here other than Santa Claus? And we're running out of time for him to show up with the package. So it just kind of feels like there's just some across the board liquidating. And could we go back down into February area? Definitely. Could we go down to that 2,500 level? Sure. And especially if we get near the end of the year, usually on the last business day of the session of the year, in that last half hour of the day, where they usually just puke out the S&Ps as they lock up their book, they usually end up buying it again. That's a trade we can talk about when we're at the options course. But there's usually a pretty good sell-off in the last half hour of the day. And that could easily take us down 20 or 30 points. So if we're anywhere near that and we fall into that zone, that would be a really great buy, I think, going into 2019. That could be the target of 2018 and the buy point going forward for 2019.
Nice. So when I look at the big picture, right, I call it the line in the sand for those, when I think about people's retirement accounts. Let me get off the ES because I don't want to delete my line. So I'll go back to the S&P. When I look at people's retirement accounts, the thing I always look for, and what I've always kind of focused on, are fresh areas where demand has been in control, some control area. as really the stopping points where if price does give me a deep, a pullback, that we'd expect a reversal. And I really do that for investing on a monthly time period, because I feel like a daily chart has obviously way too many undulations, and even a weekly chart. And so, I really felt like this was our next area for a decent stopping point, which is that 2,500 that you were just talking about, because there is a little bit of basing through here. But I say beyond that, I'm not so sure how well this is much of a stopping point. I really believe this, and I think that if we can't hold 2,500, I genuinely believe that there is a potential to get all the way back down to here, just on and I'm not saying, by the way, this is going to happen in the next 6 to 18 months, right? I don't know when it would take, but my gut tells me that at some level, this is a distinct possibility. And this wouldn't be, this isn't cutting the market quite in half. It wouldn't be on a percentage basis as big of a pullback as the last two big market pullbacks. It'd be a smaller on a percentage basis. So what do you think on that? I think you're still muted, Eric.
Okay. Well, again, you can prepare for something like that, but I wouldn't plan for something like that.
Right. Agreed.
That's where a lot of people.
I don't think to plan for it is a good idea, but I think to be prepared for it is a good idea.
Definitely.
And my problem is most people aren't prepared for it.
And there are a lot of option strategies you can put on there to create a safety net against that, being a painful device for losses. But yeah, again, that goes back to my original statement. I'm glad you agreed, is that there were too many people at the previous place that I used to work that were planning for that to happen, and were discouraging people from buying because of the potential of that to happen. And it didn't happen, but everybody's like, why don't we go down to that one? Why don't we go down to that level? That's where we're going to buy. I'm not going to buy until we get to that level. Well, if you don't buy until you get to that level, you're going to miss a lot of opportunity between there and now. And nothing is ever guaranteed. Okay? Nothing is guaranteed. The Fed, and I always make fun of the Fed because this goes way back to when I was on the floor. You would have to run your option pricing model based on your expectation of what interest rates were, or what they were going to be 3 months, 6 months, 9 months, 12 months down the road. And there's a place you can look that up. What is the Fed fund probability 3 months, 6 months, 9, 12 months down the road? But I would always run my interest rates on my model at the current rate, or maybe just a little bit higher. I would never take into account that the Fed says they're going to raise rates 4 times this year. Because how many times has the Fed said that they're going to raise rates 3 to 4 times? When we came into 2018, they were saying that they were going to raise rates 4 times, and they were going to raise rates 3 times in 2019. They were going to raise rates 2 more times in 2020 until we reached this mythical neutral level. Well, suddenly, after the market has dropped 10, 15% from its high, Powell's come out and they've basically priced in maybe 1 more rate hike in 2019. Where did all of this target go? So again, you just got to trade with what you have. You have to be very respectful for the risk that you're taking. You should prepare yourself for the possibility of something happen, so you don't have to worry about something transformative in your life because it happens. But don't spend your life worrying or getting up in the middle of the night about the potential of something losing a lot of money if you can do something proactive to protect yourself against it, or because that's just trading, folks. That is the world you live in. When you're trying to make 10, 15, 20% on an investment vehicle, well, that can go the other way. You can wake up and you can find out that your great drug stock kills people. Okay, you can find out that your Chipotle stock has made everybody in the Northwest Corridor lock themselves in their bathroom and not coming out. And then the stock's down 100 points. Okay, there's a lot of things that can just happen. You can have a missing monument. You can have something that doesn't even have anything to do with your country.
Yeah.
And all of a sudden, boom, the stock is lower. So you should always be aware. You should always insure yourself, okay, against the possibility. But don't spend your time worrying about what might happen. Worry about what's going on right now.
Yeah, that's one of the things that has always kind of driven me nuts, is that the perma bear mentality that sometimes, there are a lot of people that have kind of that perma bear mentality. And the problem is, especially when we had the market going straight up, this is one of the reasons why I am not, I really don't even go down to the 5-minute chart very often anymore, Eric. I personally have found that when I stick to the 4-hour chart and this is even for day trading, right? For smaller time frame trading, for me, 4-hour chart is really my big picture. It's what tells me, am I a buyer or am I a seller? And this is primarily for futures. And then most of my decision making is off that 1-hour chart. I'm making most of my short time frame decisions off the 1-hour chart. For those of you guys that watch the daily video, when I have a level identified, if the level identified is in green, that's on a 1-hour chart. If it's in purple, that's a 15-minute chart. I don't go any lower than 15 minutes. I've actually found way more success staying to charts that are 15 minutes or above. 15 minutes is really, to me, the smallest time frame that I go to. And I've seen that success get a lot better. But here's the rub, and I'd love to hear your comments on it, specifically in a trading style, right? So forever, a lot of this is, let me show you what for many people is the most frustrating thing in their trading. And give me your thoughts, agree or disagree. But they see this really nice, strong trend kind of rallying. And then they've got this really nice area. And this is the origin of a move higher. It's in the beginning of this. And so they're waiting for this level to get here. And then it just kind of does that and continues its move higher and never comes back down in a retest. And so what happens is people wind up missing out on trades because they're really only sticking to one trick. And the one trick is the reversal trade. Instead of trading breakouts in an effective way, where you're still using the principles of supply and demand areas and finding where's the imbalance of buying and selling and things like that, but really using breakout trades around that. So what are your thoughts on how to use breakout trades, and do you use them at all? Because I know some people don't use them at all.
Well, the majority of the breakout trades that I like are where the trend is going to be broken. Okay, there's times to be BTFD, buy the dip, and you just have to be able to identify: am I buying a dip in an uptrend, or am I buying a dip in a downtrend? Because obviously it's going to be much more probable that it's going to be a good idea for you to buy a dip in an uptrend than it is for you to buy a dip in a downtrend. Okay? You have to be more aggressive about buying that dip in an uptrend, and you have to be more defensive about buying that dip in a downtrend. And you have to be more aggressive about taking the profit on that purchase if you do buy something in a downtrend. So when it comes to that kind of mentality, listen, you have to buy small time frame pullbacks in uptrends. Okay. If you're looking at a weekly chart and you see this beautiful level of demand that you would say, oh, well, this is textbook, this is where I want to get it. Well, you're not the only person who has that chart. And you'll find that.
Oh, wait, maybe that's a downtrend.
Let's see here. Right here in October into 2016. Okay, where we had that breakout, that big green candle. Oh, I'm sorry, 28, whatever October is. It's in the middle. It's right under the word. Let's see here. Keep going, a little bit more to the right, to the right, to the right, to the right. So where did this thing break out from? Right here, right? Now there's nobody got filled on a move back down to this level, right? The candle next to it with the big wick, that didn't reach it. The candles after that didn't reach it. In what area did you finally get filled at that level of demand? Okay. You got filled at demand, but after the trend had gone from up to down. Okay. The only pullbacks I like looking at buying are the ones that still allow you to buy while the trend is still up. Buying a level of demand after the trend has gone to negative, has gone to down, those are no longer areas to initiate areas to buy. They are areas to close positions that you sold. So that's, to me, what I was a big trend proponent. Wasn't widely hailed at the previous place of employment because of that. But the reality is that you want to be buying pullbacks at the levels of demand while you are in an uptrend, and you have to be a little bit aggressive about it. When our move happened in the beginning of this year, between January and February, we didn't get a pullback that was more than one standard deviation from the highs. Okay, we never went back down from, hey, we have this big explosive move. We just kept riding at +2, +2, +2 standard deviations. And if we did get a pullback, it was like a one standard deviation pullback. It never reverted back down to a significant level of discount to the previous price until the actual uptrend broke. And then you could buy all you want. You could buy all you wanted from January all the way through that February debacle.
Well, I mean, if you liked it at 292, you'll love it at 148.
Definitely. But what about the other areas? Look at the other areas that would have been signaled as levels of demand that you would have bought after the 292 top, thinking, okay, I'm going to buy the dip. I'm going to buy the dip. I'm going to buy the dip. But you're not supposed to be buying the dip when you start making lower lows in it. And if you look at the previous, how it marched its way up in 2017, they were all higher highs. They were all higher highs. And then you start buying the pullback into not higher lows, lower lows. You're buying that is the way you join into a trend.
Right.
And everybody else just gets, well, there was demand over there. Why didn't it hold? Why didn't it shoot back up to 2075 after I bought it at 200? Because the trend's down now.
Well, and I'll spend some time. You know, we had a live trading room last night at Traders Army. It was a Q&A session, and I did a lesson on momentum. And I'm not a big indicator guy, right? I don't use indicators to make my decisions. My decisions are always made based on price action, right? But I do use the MACD as a little bit of a, call it a speedometer, right? So when I look and I see price is, now it doesn't mean that I'm going to be a seller, because it still has to give me a reason to be a seller. But if it's clearly obvious that I'm getting higher swing highs in price, but at the same time lower swing highs in momentum, then that's a signal, right? I think about it as you're throwing a tennis ball up in the air, and as that tennis ball is going up into the air, the whole time it's going up, it's slowing down. Eventually, it's going to reverse. In a time when it's an all-time high, I'm not sure when that reversal is going to occur. And so that's why you've got to have kind of that smaller time frame to determine, okay, when has my trend changed, right? And so maybe you shift to the daily. And in my mind, it's once I get a lower swing low and a lower swing high, that's really when that trend direction has changed, and it gives me a different entry.
Well, look at that that blue line you have for the simple moving average. Now, I would use an exponential, but look how, and this is, again, they went, well, why would you be selling up there? Look at how that acts as a dynamic level of supply from the 292-ish area all the way down to where we are. We cannot get price to close above that moving average. And the reason for that is computers.
Algorithms.
The algorithms, HFT, all those guys, they know that's how they play it. And you can pull up SPY, you can pull up any chart, and if you look at like a weekly or larger time frame on some of these big ticket items, that the whole point is stay long above it. And even though there's not an actual physical level of supply that coincides with that area, you have to look at that as being a dynamic level of interest, whether you're a buyer or whether you're a seller, depending on whether it's an uptrend or it's a downtrend.
See, now for me, what I'm going to look at this point, Eric, is like Yes, we're at this area. This is where I do believe in breakout style trades, but I need to see a good bit of basing before a breakout, right? So for me, Nvidia sets up for a decent little breakout below this 143.09. Now, but the problem that a lot of people have with breakouts is that they take a breakout at 140 below 143.09, and then they place their stop right here, right? They place their stop too tight. My rule on a breakout is if I place a short, if I go short right here, my stop has to be above this. Because my rule on breakouts is it's got to be above the prior pivot of the time frame in which the trade that I'm entering. And here's where I see a lot of people having a problem is this level's too wide for their risk tolerance. And when this level's too wide for their risk tolerance, what they do is they say, well, because that level's so wide, I'm going to go to a smaller time frame and just move my stop down. I completely disagree with that. I would much rather go to a different asset class, right? Or a different style of trade and place my stop where it's supposed to be. I say that especially now. You and I were talking about this earlier about futures, right? So the S&P, so the ES on this, and this is the 15-minute level that I was looking at last night, right? So last night we're looking at this 15-minute level, which is from 2666 to 2671. Now that's not bad. That's only 5 points. But even a 5-point level, if you're only willing to lose $200 in a trade, a lot of people would then change the trade and they'd move their stop when that's the worst thing to do. Here's what I tell everybody. Nobody, and The Rock means nobody, got into this business to be a futures trader. I don't care what anybody says. You might like futures because you see the potential and you know that there's good trades, but don't force a futures trade if the futures zone requires you to take more risk than you're comfortable with. Do the options trade in lieu of the futures trade, but use the futures trade to make your options decisions. So that's one of the things that I spend a lot of time teaching people, how to do is how do I use the futures, the ES, in order to make a confirmation entry or a contingent entry, on something like maybe SPX options or Spiders options or something like that.
I completely agree. And sometimes I make the reference that, as much as it doesn't sound that great to say it, but trading is gambling. Okay. And to the point that there are odds and your job is to tilt the odds as much as you can in your favor. But the reality is, since you do not control the future, you do not control the S&P 500, you are at its mercy. You are putting money down, betting on what direction it's going to go. It is effectively gambling. Now, the problem with that being gambling is when you go to Vegas, there are nickel slots up front, and there's the Michael Jordan table in the back. What you have to do when you go to Vegas, it's pretty easy for you to figure it out when you're in Vegas. It's like, wow, I'm not going to go to the $100 blackjack table with my $200 of money I brought to go gamble in Las Vegas. That's two hands. I'm not going to be able to survive the normal window of probability that there are going to be some positive runs and some negative runs, even if I know how to play this game cold. You have to find the table limit that fits the methodology that you're going to utilize. Right. So if you can find a $5 table, you should be at the $5 table. Okay. Yeah. Who wouldn't want to be with the showgirls and the movie stars in the back room? But you don't have the account size to do that.
Right.
And if you're going to be in there, like you said, with that, having a stop that's $6 wide or something along that line, especially in an environment where we're one tweet away from being up or down 20, that's not your table. Right. The good thing is that there are the ability to read a chart is universal. There is no ES chart reading school, and then you have to go take the USO chart reading school. You're learning the fundamentals about what it is. And some people go to the table that, the stock has an average to range of $1.50 a day. Some people go to the table where the underlying has an average to range of 50 cents a day. And then some people are out there trading Amazon where it might move $50 a day. Those are the different tables in your Vegas. So if you're looking at an ES table, maybe ES isn't right for you because of the magnitude of that move. But if you are going to be determined to do that, then if you look at an options page, you'll find that there are mini tables in the ES casino. Okay, there are smaller tables, but you're not in the universe of the market, the casino of the entire market. Now you're at the casino of ES. And when you break open ES's casino and you look inside there, you'll find that there are options that are going to move 20% of the price of ES. So instead of a $5 move that's affecting your account, it's only going to translate into a net $1 move, even if it moves $5. There are some that might be move 20% or 30% or 50%. There are a ton of little tables that you can be playing at and still play at the ES casino.
Right. So here's the other thing that I like the analogy of gambling, because I do believe that it is. I love the analogy of poker. A slightly different version of that is thinking of it more like poker, right? Because you've got somebody in the middle of that trade is the broker, right? They're the ones that are taking a little bit because you're going against somebody else. No matter how good you are in poker, if you don't get the cards, you don't get the cards, right? But sometimes you can be a good poker player, a bad poker player, and get all the best cards and still screw it up because you got bad money management and bad bet management. So I've really liked the analogy of poker because of that piece in there. So that's just kind of my thoughts on that. So we got a good question in the chat box, Eric, that I'd like to touch on. Seema would like to hear your thoughts about options in current market conditions, and I want to get to there, but I promised everybody that we would try to be out. That we would try to be out in an hour. So I want to share this real quick, and then after I share this, then we can. I'd like for you to talk a little bit about options in the current market conditions, especially in a condition where we have tweets, where we have, as a tweet comes out, we can kind of see what happens. But I mentioned earlier that you are going to be in Houston doing the options class. So the options class, for those of you guys that are interested, it's January 9th to the 11th. Where the idea is that the basic stuff of options, what's a call, what's a put, what's a bull call spread, what's a bear put spread, all that stuff, you're going to have home study material for that. We want to actually start off significantly higher level a little bit, but give you the tools so that you can get the foundations on your own if you need them. But it's going to be Eric and I both. And so this is a rough idea of kind of what we're going to cover. But the idea is that you bring your own laptops. You're going to get a chance to kind of, trade it on your own if it's something that makes sense to you and something that you want to spend a little bit more, dive a little bit deeper into it. And I'm looking forward to kind of hearing some of the strategies that you have, Eric, specifically around volatility and what it is that you do. So for those of you guys that are interested, January 9th to the 11th here in Houston, if you go to, hold on, let me pull it up. I'll throw it in the chat box. Here's the website, tradersarmy.com/option-trading-intensive is how you can get it. I think we've got only about 8 spots left. I want to keep it. I want to keep the class very small. So those of you guys that are interested, that's where you will find the information. So I'll leave it. The chat box is open if you guys have any questions, but I'm going to type that link into the chat box. So if you guys want to go to that, you can. Eric, anything to add on that?
No, I'm looking forward to seeing all the faces.
Yeah, it's gonna be fun. We're limiting the class to we're limiting it to 20 people. We've got about I think we've got about 10 in there that are confirmed now. So we'll see. I got spots for and two of them that are supposed to come in. So we got room for a couple of more. So if it's something you want to do, awesome. If you do want to do it, real quick. Oh, I forgot. Hold on, let me pull it up. So I'm going to type in promo code OCHO10 +1. There's your promo code. If you decide you want to do the class, you're going to get 10% off the tuition plus 1 month of Traders Army's subscription goes along with that. And the reason we give you the 1 month of the Traders Army subscription to go along with it is so that you have time to watch the home study course before you come to the live class. So that's the promo code OCHO10 +1. So awesome. All right. So Eric, when we're looking at current market volatility and kind of where we are, and I'm going to throw the VIX up here real quick because I think the VIX is always fun to talk about. Is it real? Is it not? What are people doing with it? What are they using it for? What option strategies are you finding specifically valuable in this market, and what are some of the things that you're looking at? Because that's one of the questions that Seema had asked.
Okay, so this goes contra to a lot of things that you've heard about the use of options. There's a group out there that stands on top of the soapbox and says, I don't need to know where the market's going. I just need to know where it's not going.
Oh, kill me.
And those are the worst people ever. Because for one thing, they do not know where it's not going to go. Bottom line, they do not know where it's not going to go. And in a little bit of spiking the football here, everybody that I know from there's professional options trader, floor traders, market makers, guys running hedge funds, whatever it is, the people that made the most amount of money are not people that make the bet that they sell premium based on the idea where they think it's not going to go. Now you can make a living doing that. You can pay your bills doing that. Okay, and be a premium seller and hedge things and go back and forth and do a lot of work and make your brokerage firm a lot of money in the process with a lot of commissions and a lot of selling junk and hoping that nothing bad happens at 3 a.m. But the people that make the most amount of money are net long units. Okay, they have more calls long than they have short. They have more puts long than they have short. My claim to fame is that back in early 2000, 2001, I made $1 million in 2 days because the day before the company I was trading came out with this announcement that it had settled a patent dispute with another company. I think it was Samsung or something like that. The day before that, I had net bought a whole bunch of calls, somewhere close to 500 calls for like 25 cents each, and I had sold some larger dollar value options that created an offset to the cost of the options that I had bought. Okay, so I may have spent $12,000 on some calls for 25 cents, but I had sold other units for dollars that allowed me to have a very significantly reduced cost to that position. And then the stock opened up $18 and boom, ended up making $1 million. A friend of mine trading in Delphi had the same position, but in the opposite direction. He keeps buying a bunch of puts that were very small dollar value puts, and he paid for it by selling a handful of higher dollar puts. And he went on vacation to Europe, and something happened to Delphi. That was when there was that nonsense in 2006, 7, and 8, or whatever it was. And he came back, and he had lost money on a handful of puts, but he had made a ton of money, $500,000, on the puts that everybody in the world thought were worthless. It's like, why would anybody be long a 5-cent put? Why would anybody be long a 10-cent put or a 25-cent call? Those are free money. Stock's not going there. All I got to do is sell that for $1.50 or 50 cents or 10 cents. And let's see, let me figure out what I want to spend this weekend. And that's how many I'm going to sell. Well, the thing is, as long as an option is alive, okay, it has days till it expires, then that option has the potential of having value. Just because people perceive it to have or assume it has no value does not mean that it is actually an option that is guaranteed to have zero value. It's just that the current universe of people out there don't ascribe it a value enough to raise its price. All options are based on what somebody is willing to pay for that option because of what they perceive as the probability or possibility, not necessarily probability, but the possibility of that event occurring. So if I go, and I'm going to share my screen here.
Awesome. Let me stop my screen share, and then you can share yours. Oh, no, but now people, I think, see my face again.
It's infinite regression. Okay, can I see this? Okay, so this, you should be able to see this SPY thing. Now again, S&Ps or ES futures are down 15 points. Now, if you're wondering what came out that was down 15 points, this is my shout out to Zero Hedge. I go over, I flip to it. There's a story that claims that Donald Trump was in the meeting that involved hush money for the Inquirer story that got tanked. So if that's true, the algos are reading these headlines. The algorithms actually read tweets, okay? And they buy and sell. They don't wait for a human being to push that button. They read and they can, artificial intelligence, it's trading for them, and then they start selling futures. Now, if it turns out to be a false story, you have a big reversible. Right now, nobody's really watching it. The algorithms are reading tweets, and that's why we have this breakdown. Now, if you look at this moving average here, okay, that comes in at 263.85. We're actually below that now, okay? So if I'm looking as a macro trader, I'm concerned about the potential of this taking another leg down, okay? This leg down could take us easily down to 240, okay, in this area. Now, again, I don't know this to happen, but I could go into, let me do it with a different one because I think I have a position in that. So let's do the Qs instead. It's going to look somewhat the same. So if you're worried about it breaking this trend at 160, you can go to the option page. And look at all these options here. They're 5 cents, and there's only one day to go. 5 cents, 6 cents, 7 cents, 9 cents. You think, well, why would I want to pay 9 cents for one day? Well, you don't necessarily want to, but what if you did this? What if you went out and you adjusted the position here and you said, let me buy 10 of these. Okay, 10 of these for 8 cents each. And I went and I sold 2 of these for 46 cents. So what I've done is I net have 8 long units, okay? 8 long units because I'm long 10, short 2, and the total cost of this is actually a small credit. After commissions, it's probably a push. But if we didn't know, no, this is before we knew that the S&Ps were going to be down 20 or the Nasdaq was going to be down 61. And again, we're breaking through that macro level, so it's starting to get people to trigger to sell because it is a worrisome level for long-term macro uptrend, guys, when you start seeing us breaking below that 2640 level. So if I go look at this, let's say you went home and you thought, I've got some tech stocks. I don't want to sell them. I've got a position in the Nasdaq. I don't want to sell it, but I do want to protect it in case something crazy happens. Well, what would have happened if we had no news come out and we weren't down 58 on Nasdaq futures? Well, then this whole thing right here would expire worthless. You'd buy this back at 2 cents, these would be worthless, and the whole exercise would be worth nothing because we went higher. We could have dropped from 65 to 64.5 to 64 to 63. In fact, we're still at a point where if we close here, this entire position is worthless. Okay. Where is our window of risk? Our window of risk is between 63 and 60 and a half, or 60. So you're thinking, well, wait a minute. If we go down to 160, aren't I going to lose $300 times 2 because I'm short this put and these options are going to be worthless? Well, here's the thing. If we had a news story where we gap down to 159, okay, 159 to 160 would be $1,000 on the 10 lot of puts you bought. 10 puts for making a buck on 10 puts would be $1,000. Losing 4 points on 2 puts would be losing 800. So if there was a big event that could take us down 4%, then you have 8 puts that are just a free run once you get below basically 159 and a quarter. But then you think, well, wait a minute, that's kind of a binary outcome here. Either we do nothing or we have to crash. What if we were to gap down to 161 or 161 and a half? Well, let's look at the chart. Let's analyze something like that. And let's just look down 1%. Okay, so yeah, if it grinds down, well, actually this is a little messed up because it already is taking into account that we're lower. But you'll see that going from here down to 160.
Can I interrupt you for 2 seconds, Eric?
Sure. Can you see this?
One of the things, for those of you guys that are not familiar with what Eric's doing right now, is he's analyzing the risk graph. And not all of you on here are options traders, but I will stress this till I'm blue in the face. One of the most important things that you need to learn if you're going to trade options is how to read and manipulate risk graphs for both changes in time and volatility, because that is a huge part of options trading. Every options trade that I set up that has more than one leg for certain, I'm going to take a look at the risk graph and see what's an effect. What is that? What is time going to do to that trade? What is volatility going to do to that trade? And then based on where I think price is going to be, that's a huge part of what we're going to spend a lot of time covering. All right, carry on. Sorry, sir.
I agree 100%. And when I was a floor trader, before we had the, and again, this was when we used to, just basically use sharp sticks and rocks in order to trade. We didn't have the real-time tools that you have now. So again, you got to set the Wayback Machine to 10, 15 years ago, where we actually would take our positions and they would be full of options, and they wouldn't be very simple option strategies like just one call or doing a bull call spread or something along those lines. As a market maker, you had to take all the trades that everybody in the world wanted to do and compile them down, distill them into one graph. So whether you have some January options, some February, some June, some next June, 10% out of the money, 10% in the money, whatever it is, it all gets compiled down to the fact that the sum of their participation is their delta. Whether you have just this little position or you have 1,000 options, it will all distill down to what is the total delta of the position, what is the total time decay, and what is the total volatility exposure of the entirety of the mess that you've created. And we would print these out, and we would have all of these different slices, and we'd want to know if we go down 1%, if we went down 1 standard deviation, if we went down 2 standard deviation, what is my position at that level of price? So it's not like, oh my God, let's open and find out what my deltas are. I know what my deltas are. I know that if we were to gap down 2% beyond where we are, the position would reflect that I'm short, even though that those puts are still a little bit out of the money. It's telling me that I am short effectively 250 shares of Qs at that point, and that I've made a small amount of money in that move. And if it goes down another percent, then I'm making more money and I have a greater short position as it goes lower and lower and lower. These are great for tweet defense trades. These are great against Trump defense trades, because when you're sitting in front of your screen, I put these on all the time because I never want to have to say when I've got a position or a portfolio that I want to have to do something on a spike up in price that I don't want to do, or I have to do something on a spike down in price that I don't really want to take the action because I know it's just a knee-jerk reaction to some tweet that could easily be reversed. How many times have we been down 50 and then close back unchanged, or run up 40 and then close back unchanged? So if you don't really want to have to bite on that, but you know that you have the participation if you wish to, you can go out and put these kinds of positions on and say, listen, if we really break down, I've got these extra puts that are going to make me a fortune if we just keep going lower. If we have something where it works to the upside too. It's much cheaper on the upside because we don't crash up. So if I take this, and I take this, what if you were worried about there being a positive story out of some sort of trade agreement? Okay, 68, that would only be 2% higher. You go out, you buy these. Oops. Now you do spend a little commission on this. Okay, but this would be free. And if nothing happens, the whole thing goes out worthless. If there's a huge story, then it goes higher. And you have the extra 8 units. Yes, you had to worry about this a little bit. But again, if we grind up slowly, is that the thing that you're worried about? Are you worried about a slow grind up from 265 to 166 and a half, from 65 to 66 and a half? Or are you worried that there's going to be a Brexit breakthrough? There's going to be a trade breakthrough. There's going to be something that's going to be a very positive gap up. If you do, you want to have the extra units, because you can easily say, oh, well, we grind up a little bit. I sell these out for the same 9 cents I bought them for, and I buy back these for 10 or 15 cents higher than I sold them. I was protecting against the gap. Didn't happen, but man, I got a great night's sleep. And if we start going down, you don't have to worry about it at all, because the whole thing will wash itself out. But it didn't cost you anything. You didn't spend $90 because you were worried about the gap up. The whole thing is free if we just go lower. And in this case, trading 163, if you did buy this position worrying about the upside, worrying about a short position, or worry about not having enough upside participation if we did go up, then the whole thing is just washing out. And instead of spending $90 and watching you lose it, this whole thing is nothing, and the stock is down basically 1%. So these little tips are ways that you can actually make a pretty good, have the lottery tickets. Now, again, if you don't want to do something that expires in one day, okay, you can go out to a farther time frame, but you're not going to get the same measure of that ratio, okay, because there's a lot more can happen within that time frame. You have to pay a little bit more. Here you could go sell, adjust position, sell 1, and you could go down here and you could buy 3. And let's get rid of this. Let's analyze this, and we'll get rid of these 2 things. And if it goes lower, what happens? You get shorter and shorter as the underlying drops over the next week. And if we go up, what do you lose? If we go up from, and again, we're looking at, I got rid of those. Can't make that move. And if we never go below 160 and a half, then the whole thing washes itself out, and you actually make, I think, $10 on this, because you're selling it for 90 cents and you're selling this for $1.06 and you're buying this for 96. So you actually make $10 even if nothing happens. If it goes up, no problem. If it stays the same, no problem. If the market crashes, you've got all of this downside potential to make money. If it grinds down, well, you can always defend against a market that's grinding down. What you're worried about is gapping down. So you can put these all over the place, whether you're worried about an individual stock, works in Apple, works in IBM, works in oil, works in everything. So you have this huge window of no loss, big gain, and something very manageable in that window. And those are the little kind of tricks and tips you can pick up, and that can just another tool in the box.
Nice. Awesome, man. Appreciate that. So guys, you know, this is, I'm looking forward to this class coming up in January. For those of you guys that are interested in coming, I really, it'd be great if you get a chance to come in. I'll put it in the chat box again. For those of you that are interested in coming, we got about 8 spots left, and it's in the Houston area. And you know, if you live in Chicago, Houston's nice in January. Chicago's not. So I hope you guys enjoyed this evening's session. If you've got any questions, please feel free. You can send me an email. My email address is support@tradersarmy.com. There's just, now I will tell you this, there is only 2 of us at Traders Army. We've got myself, and we have one of my longtime trading friends and partners, Mike. He kind of watches the support side. So put it this way: if you send me an email, we don't get back to you in the next few minutes, you're not bleeding on a gurney, and we're not doctors. But I'm positive that if you come to our options class, that you will find it will be an awesome event. And I really appreciate you guys all making time to join us here this evening. Eric, thank you so much for coming in. It was absolutely awesome. I'm gonna turn this broadcast off. Anything else to add, Eric?
Nope, it was fun. We'll do more of them.
See you guys all soon.